Imagine owning a company worth potentially over $100 billion, generating nearly $20 billion in annual revenue, and billions in operating profit, without a single public shareholder telling you what to do. No Wall Street earnings calls. No quarterly investor pressure. No stock ticker. And yet, two brothers quietly control one of the most powerful luxury businesses on earth. This is Chanel. And the most surprising part isn't how much Chanel makes. It's how the company became this powerful without ever needing the public markets. When most people think about the world's biggest luxury companies, they think of LVMH, Kering, or Hermès. But Chanel is different. Chanel is privately held. The company is controlled by brothers Alain and Gerard Wertheimer, descendants of Pierre Wertheimer, the businessman who partnered with Gabrielle Coco Chanel in the 1920s. That means Chanel doesn't have the same ownership structure as a publicly traded corporation. There is no daily Chanel stock price. No army of public shareholders. And no obligation to optimize the business around the next quarterly earnings report. Instead, the owners can think in decades. And that difference may be one of Chanel's biggest competitive advantages. Because luxury is not built like a smartphone company. You don't want customers buying a Chanel bag because it's cheap. You want them buying it because it feels difficult to obtain. And Chanel has spent more than a century building exactly that perception. Now let's talk about the number that makes this story fascinating. You may see Chanel described as a company worth around $150 billion. But there's an important distinction. Because Chanel isn't publicly traded, there is no official market capitalization telling us exactly what the company is worth today. Instead, private company valuations are estimates. Back in 2019, analysts already suggested Chanel could be worth around $100 billion or more. And Chanel has continued generating enormous amounts of revenue. In 2025, Chanel reported $19.3 billion in revenue. Operating profit reached $4.712 billion. And free cash flow reached $2.646 billion. So the real story isn't whether Chanel is exactly worth $150 billion. The real story is this. How does a private fashion company generate the economics of a global corporation while protecting the exclusivity of a luxury brand? The answer begins with one of the most powerful concepts in business. Scarcity. Chanel sells handbags, perfume, clothing, watches, jewelry. But that's not really what customers are paying for. They're paying for something much harder to manufacture. Status. Think about the difference between an ordinary product and a luxury product. If a company wants to sell more ordinary products, it usually tries to lower prices, increase distribution, and maximize volume. Luxury works differently. Too much availability can destroy the very thing customers are paying for. If everyone can easily buy something, it becomes less exclusive. And if it becomes less exclusive, its perceived value can fall. Chanel therefore operates in a world where demand isn't the only thing that matters. Perception matters. Heritage matters. Design matters. And scarcity matters. That allows Chanel to sell products at prices that would look irrational if you judged them only by manufacturing costs. Because a $10,000 handbag isn't worth $10,000 because of the leather. It's worth $10,000 because of what the Chanel name represents. And that is one of the highest margin assets a company can own. A brand that people emotionally value more than the physical product itself. And this strategy has created enormous financial results. Chanel's 2025 revenue reached $19.3 billion. But look deeper. The company generated approximately $4.7 billion in operating profit. That's roughly a quarter of revenue before considering other items. And Chanel isn't simply extracting cash from the brand. It's reinvesting aggressively. In 2025, Chanel invested about $2.4 billion in brand activities, while capital expenditure reached approximately $1.45 billion. Why spend billions when the brand is already famous? Because Chanel understands something many companies forget. A luxury brand can be destroyed by short-term thinking. If Chanel maximized profit today at the expense of brand prestige tomorrow, it could damage an asset worth far more than a single year's earnings. So Chanel plays a different game. It is essentially investing in something Wall Street cannot easily measure: future desirability. One of Chanel's greatest strategic decisions came in 1983. The company brought in a relatively unconventional creative force: Karl Lagerfeld. At the time, Chanel was an iconic name, but the brand needed modernization. Lagerfeld didn't simply copy Coco Chanel. He did something much more difficult. He took the original DNA and made it relevant to a new generation. The tweed, the chain, the double C, the black and white aesthetic, the codes of the house. Instead of destroying the heritage, Chanel turned heritage into a platform for reinvention. And that's a crucial business lesson. A luxury company cannot live only in the past. It has to make the past desirable to the next generation. Lagerfeld remained Chanel's creative director for more than 3 decades, until his death in 2019. That kind of continuity is extremely difficult to create. And it helped turn Chanel's history into a financial asset. Now imagine running Chanel as a public company. Every 3 months, investors would ask, why aren't sales growing faster? Why are margins down? Why are you spending billions on stores? Why are you investing so much in brand experiences? Why aren't you opening more stores? Why aren't you selling more products? That pressure can be useful for many businesses. But luxury is different. Sometimes the correct business decision is to spend money today for something that may pay off 10 years later. Chanel's private ownership gives its leadership room to make those decisions. The company continues to invest heavily in craftsmanship, stores, client experiences, fashion, watches, jewelry, and brand development. This creates a fascinating economic advantage. The company can sacrifice short-term efficiency to protect long-term desirability. So why doesn't Chanel simply launch an IPO? Because an IPO would solve a problem Chanel doesn't really have. Public markets are extremely useful when a company needs capital. But Chanel already generates billions in revenue and billions in operating profit. It has positive net cash. And it generates substantial free cash flow. So why give up ownership and introduce public market pressure if you don't need the money? That's the key. For Chanel, going public isn't necessarily an upgrade. It could actually be a trade-off. The company would gain access to public capital, but potentially lose some of the independence that makes its strategy so powerful. And for a family that has controlled the business for generations, that may be a very expensive trade. The Wertheimer family's strategy goes far beyond simply owning a fashion label. They've built around Chanel a long-term investment structure and family-controlled capital. The family has also operated through Moose Partners, a family investment office involved in investments outside Chanel. This creates something that public corporations rarely possess: patient capital. A public CEO may have 5 years. A private family can think in generations. And when your core asset is a 100-plus-year-old luxury brand, generational thinking becomes a competitive advantage. Chanel doesn't need to win every quarter. It needs to still be desirable decades from now. That's a completely different definition of success. So what is Chanel's actual business model? It isn't simply make expensive products, sell them, make profit. It's more like build heritage, create scarcity, protect exclusivity, Increase desirability. Justify premium pricing. Generate high cash flow. Reinvest in the brand. And repeat. That's the machine. And every part reinforces the next. The higher the perceived value, the more customers tolerate premium prices. The more premium the prices, the more money Chanel can reinvest. The more Chanel invests in craftsmanship, stores, fashion, and experiences, the stronger the brand becomes. And the stronger the brand becomes, the more difficult it becomes for competitors to replicate. That's a moat. Not a patent. Not software. Not a factory. A psychological moat. And that's why the Chanel story is much bigger than fashion. Because Chanel has demonstrated something powerful about business. You don't always need public investors to build a global empire. You don't always need maximum volume. You don't always need the lowest price. And you don't always need to chase every customer. Sometimes the most valuable thing a company can do is convince customers that they cannot easily have it. Chanel has spent more than a century turning scarcity into desire. Desire into pricing power. And pricing power into billions of dollars in cash flow. Today, the company remains privately controlled by the Wertheimer family, while generating nearly $20 billion in annual revenue. So maybe the real question isn't, how much is Chanel worth? The better question is, how much is a brand worth when the people who own it don't need to sell? And that may be Chanel's greatest luxury of all.